Welcome to Breaking News to Trading Moves. Today we're looking at a major leadership transition in the energy sector.
And more importantly, how the market is translating that one corporate decision into a pretty wide speculation about industry consolidation.
It seems like a classic case of a change at the top, immediately resetting expectations.
It is. The CEO replacement at BP, which was not widely expected, is being read on trading floors as a signal that we might be seeing a return to mega merger activity in the oil and gas space.
And this one leadership move could set the tone for capital reallocation and, asset discussions for the next 6 to 12 months.
Absolutely. So today we'll get into the details of the CEO replacement, explore why traders are anticipating M&A activity right now, and then identify the companies and market segments being viewed as immediate winners and losers from all this speculation.
Okay, let's start at the beginning then. The corporate catalyst at BP.
The headline event is that BP is replacing its CEO, Murray Auchincloss.
And we know who's coming in. The material specifies Meg O'Neill, currently the CEO of Woodside, has been appointed as the next CEO. She starts in April.
Right. And until then, BP's trading chief, Carol Howle, is serving as the interim CEO. But the market's interpretation of who they hired? That's everything here.
O'Neill's background, that's the signal.
Exactly. She's running Woodside right now, which is a massive Australian energy producer. They're known for large-scale liquefied natural gas projects and for very disciplined, very efficient project execution.
So if BP picks a CEO who is known for driving scale and getting the most out of hydrocarbon assets, well, that tells you a lot about the direction they're planning to take.
It really does. This appointment is seen as the BP chair looking for a more forceful reset of the company's strategy.
And BP was already kind of refocusing on its core oil and gas business.
It was, but bringing in someone like O'Neill just accelerates that whole discussion. The question now is whether BP is positioning itself to buy other assets, or if it's potentially getting ready to be bought by an even larger competitor.
That's the fundamental strategic question for them now. Their underlying direction was already becoming clear. More oil and gas development, cost-cutting, and selling assets to lower their debt.
But a new leader, especially one with a reputation for execution like O'Neill, doesn't just continue that strategy, she can speed it up dramatically.
Meaning faster capital reallocation inside the company.
Yes, directed toward high-margin upstream projects. And this focus on maximizing current assets and increasing scale is the direct fuel for all the market speculation we're seeing.
Which brings up the bigger question for the whole sector. Why is maximum scale the top priority right now? Why are these huge combinations suddenly on the table again?
Well, if you look at the broader environment, the prevailing belief in the energy industry is that global demand for oil and gas is going to remain durable for decades.
Okay.
So if that's your starting point, then achieving massive scale, maximizing your operational efficiencies, and finding cost synergies, that becomes your #1 corporate goal.
Efficiency through sheer size. That logic makes these huge combinations, which might have seemed, a bit extreme a few years ago, suddenly feel very plausible.
And this is where the market gets both nervous and excited. Scale requires consolidation, but these mega mergers would absolutely trigger complex and prolonged regulatory reviews.
They have to sell off assets, right? Overlapping refineries or production fields to satisfy the regulators?
Yes. But the strategic goal of long-term efficiency and market dominance, it seems to outweigh that near-term logistical difficulty. And that brings us to the trading dynamic.
Right, because the trading impact doesn't wait for a deal to actually close.
No, not at all. Even if no deal ever happens, the potential for a deal changes the valuation today. This is what's referred to as M&A optionality.
M&A optionality. So it's like a premium the market assigns to a company just because it might be involved in a merger.
Think of it like a financial option, yeah. It's based on the chance a transaction happens. And that optionality lifts the valuation floor for companies seen as targets. It increases implied volatility across the sector, and it causes a repricing among peers.
Especially those U.S.-listed majors and their American depository receipts, the ADRs.
Exactly. It's the possibility, not the reality, that's driving the price action.
So with this new landscape BP signaling aggressive execution, the industry focused on scale. Where is the money flowing? Let's start with the companies that could benefit from this speculation.
Okay, we can break the immediate beneficiaries into 3 main categories. The first is what we can call consolidation re-rating. This is among the large integrated oils themselves.
And the logic here seems pretty direct. The CEO change and all this talk of consolidation puts a takeover or merger premium back into the shares of these companies, even with no formal announcement.
Correct. They get priced up just because they might be players in the game.
Hmm.
The companies noted here are BP, that's BP Shell, ticker SHEL, and Total Energies, which is TTE.
The big European players.
The very same.
Yeah.
Their future structure is now what's being heavily debated.
Okay, the second category is the deal machine beneficiaries. We're talking about the financial institutions. Why do the banks automatically win here?
Because energy M&A on this scale is just colossal. These mega mergers generate enormous advisory fees. They need huge financing packages. They create a lot of hedging activity, and they boost trading volumes for the banks.
And the timeline is key here too, right? These deals take a long time and involve extensive restructuring work.
Which means sustained, almost guaranteed revenue for the financial sector, sometimes for years. We're talking about the major investment banks that handle these deals. Goldman Sachs, ticker GS, JP Morgan Chase, JPM, and of course, Morgan Stanley, MS.
Makes sense. Now the third category of winners, the upstream intensity winners. These are the oil field services companies, the ones providing the tools.
Right. If BP's new direction means leaning harder into upstream growth and project execution, more E&P spend, then the companies providing the picks and shovels often see the most stable demand.
Their business is less volatile than the producers themselves.
Often, yes. They're providing the specialized equipment, the tech, the labor needed to get the oil and gas out of the ground. The names to note in this group are Schlumberger, ticker SLB, Halliburton, HAL, and Baker Hughes, BKR.
Okay, so now let's flip the coin and look at the market losers, the companies that might see some selling pressure from all this. We start with a kind of counterintuitive one, the buyer risk basket. The potential acquirers.
Yes, the company doing the buying often sees its stock take an initial hit.
Why is that?
Well, there are concerns about immediate dilution for shareholders, the inherent risks of integrating two massive businesses, which is never clean, and the threat of being forced to sell off assets by regulators. All that can weigh on the share price right away.
So the companies with the biggest checkbooks are the ones that could take the initial hit. Is that market reaction just fear of the integration process?
It's priced in fear, yes. Even if a long-term strategic goal is solid, the market prices in the execution risk immediately. The U.S. majors listed here are ExxonMobil, ticker XOM, Chevron, CVX, and ConocoPhillips, COP.
They have the firepower to be the buyers, which means they're subject to this buyer hit.
That's the idea.
Okay, on to the second basket of potential losers. This one looks at energy transition sentiment, specifically the clean energy names. This is more of a read-through effect.
It is. If investors interpret BP's move hiring a CEO known for hydrocarbon execution as a signal that majors in general are going to focus less on their renewable ambitions, it can cool investor sentiment for the whole clean tech space.
And this cooling can affect these companies even if their own individual performance is fine. It's all about sector perception.
Precisely. The companies flagged are Enphase Energy, ENPH, First Solar, that's FSLR, and NextEra Energy, NE.
Got it. And the final group we need to cover is the third category of losers, downstream uncertainty. This one focuses on U.S. refiners.
When you talk about massive mergers, you're almost always talking about potential downstream asset sales. Regulators watch market concentration in refining and distribution very closely.
So they'd force the newly combined company to sell off some of those assets to maintain competition.
And that creates near-term uncertainty. Uncertainty about shifting crude flows, which refiners rely on, and possible margin volatility. The market tends to price that uncertainty into these stocks pretty quickly. The companies mentioned are Valero Energy, VLO, Marathon Petroleum, MPC, and Phillips 66, PSX.
So to sum up, we've tracked how one change in the executive suite at a major oil company, BP, can recalibrate market expectations across the board.
It creates M&A premiums for some and integration fears for others. The entire market narrative for the sector has been altered just by observing who BP put in the corner office.
And what that personnel decision implies for their future focus on hydrocarbon execution and maximizing scale. Now, this whole discussion is really centered on the majors, the largest integrated companies out there.
Which leaves an important question for you to think about. If the strategy for the largest companies is now moving toward maximum scale, what does this aggressive focus on consolidation imply for the valuation and maybe even the independence of smaller, non-major energy producers in the near future?
Something to consider as you watch the sector. Thank you for joining us for breaking news to trading moves.
Before we go, a quick reminder. Please remember that this information is not financial advice, nor is it a recommendation to buy or sell any security. This presentation is purely the opinion of the author based on the material provided.